the insurance behind MF Global basically is transferred away to someone else, and I'm pretty sure. I'm guessing. I was guessing actually, but it's obvious. I mean, if everybody's using synthetic risk transfer products, right? They're gonna obviously do that with the insurance premiums they get from the brokerage houses. Um, uh, every month or every year or whatever it is to package it into a synthetic instrument and sell it off so that the CME not only transfers the risk, but they also make some money off of this as well. So they don't have to really invest the insurance premiums themselves. Uh, this what it does is they package it up into tranches and so forth. This document here that you see here, um, link will be below. Um, Basically outlines how that works, and it's a very complicated thing. It's but the basic outline of it is basically, they take the insurance premiums and make it look like a debt instrument, because you know how you'd make your monthly payments to your life insurance. Um, Basically, that can be turned into like a debt instrument because it's just a monthly payment. So you could say, okay, well, you know what, that payment against, your quarter. Let's just say you're paying $100 a month for a $500,000 life insurance policy. Well, it's the $100 a month payment on a $500,000 debt in a sense, basically. So you could treat it like that, and and then sell it off as that particular product, like a debt instrument. And then that means that reserve and the banking industry can actually monetize those instruments as well. So it gets a little bit more complicated than that, because obviously $100 is not going to cover um, a $500,000 debt, but basically just showing how they can change it into a debt instrument, um, in a simple form, so that you can understand it. Now, one of the things that's got me concerned with this is that banks give you free insurance, life insurance, in the states, and they're trying to do that here. They don't really do it here in Canada. They they charge you for life insurance a small amount, but it's still the same thing. And what the banks are doing, of course, is they're going to create these synthetic transfer of risk products, or CDOs, and sell them off. And basically, what makes it worse is that they're probably already betting against these things. And you're like, what? you, you're effectively betting that the people are going to die. Well, as you can see, um, you know, you could put two and two together and think about, well, wait a minute, I remember watching a video about a whole bunch of coffins in Atlanta. Yeah, don't be surprised, right? Because you know what, if they kill people, start killing people off, because you're thinking, whoa, now you've gone off the deep end here. But hold on, please, pay close attention to this. Um, Basically, you got to think about what advantages they have here, right? I mean, they're getting away with murder right now, and with, well, not murder, but you know what I mean. They're getting away with stealing your money, right? Going into debt, and not going into debt, but you know what? They're basically creating a bunch of products that are gone bad, and then they're getting bailed out. So it's not a stretch to have to for them to have mass murder and get bailed out and by the government and not go to jail for it. Because here's the thing, right? Um, if you die, right, and your insurance pays out, there is also this thing called death taxes, which the government gets 50% of. So the banks bonus out by your death, right? Because they're betting against they're betting against those products, the transferred risk products that they sold, and then on top of that, the government gets the 50% of um, your death. What's it called? Your insurance premium, um, because of the death taxes, and so it makes it harder for them to investigate the banks when when your death keeps the government alive, and then on top of that, right, the banks also get the money because you know what they have a whole bunch of treasuries, right? So on their balance sheet as well. So the interest payment to the treasuries of the treasury notes are going to the banks as well. So it's a triple win for the banks, right? Your death. So are they gonna do it? I don't know, right? but it would be a good idea for you to not go into those free insurance that the banks are offering you. Not to use bank insurance. I'm not saying cancel your life insurance, but it's probably true for your current life insurance, whether it's it's $500,000 or whatever it is, quarter million, $1 million, whatever. They probably already done that to your insurance policy. Now, this is the way it is. We can't change it. That's what's coming down the pipe. I can't tell you if they're going to kill you off. I'm not going to say for sure, but hey, you know what? Um, if they see a chance to do so, it would be very profitable for them. So just keep that in mind. One more bonus thing. Option arms. You heard about all the what's it called, the mortgages going under. As you can see right here, this is exactly like subprime that we're going through. You'll see subprime in 2007 here was like really peaking out here. Well, so we're gonna see an interesting 2012 maybe. The only issue that I don't see the issue with that is that um, we're not seeing them denying it, the banks. So maybe there might not be an issue here, but because they're not denying it, if they were denying it, it would have been hello, obvious. But they're not saying they're not. Ben Bernanke's not coming out and saying that there is no adjustable rate problem, mortgage problem, or whatever or not. If he was, then and I missed that, please let me know, because that's a clear sign that this this option Armageddon is truly Armageddon. All right, thanks for watching, and I hope you enjoyed this video.